Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about options volatility surfaces, the Greeks, and our earnings calculations. Matt, do you want to share your screen and go over our long put calendar trade from last week?
Sure. So last week, markets were crashing and people are asking, hey, is there a trade that we could do or is it too late? And I said, well, you don't want to get aggressive when they're actively crashing. So the least aggressive that you could have and still want to have some protection is a calendar. Of course, we've been talking on the show to always have some protection even when the market looks good. You never know what's going to happen, and lo and behold, that's what happened. Market lost quite a bit. So we put on so I have here the trade history, and the trade history we put it on at $5 and it went up to 567, and then the market rallied, and so it's come down, and now it's about $5 again. So this is a nice strategy to have something on, and be able to have some protection when the market goes down. What will happen is it's so out of the money that you're it's basically a 1-year calendar, but July has a lot more theta. So July is worth $1.89, and then whereas the June's worth about $6.76, $6.80. And so what will happen is, even if it starts going down towards the 400 strike, the June will get much larger than the July until it goes through and goes to parity, of course, and then they equal out. But that's way down. What we're protecting against is something going down towards that strike. So it's still a pretty decent strategy to have on, especially if you don't have the protection already. The volatility, there is Vega in this, and the Vega's up a bit. So if the market corrects and volatility comes down, it's going to get hurt, but at least you have something on. Does that make sense, Tyler?
Right. So what are you looking for the market to, how are you looking for the market to behave for this trade? Flat, going down further? Is it protection? What is it?
Well, I don't ever like to predict the market, but I always like to have some protection on. And the questions that we were getting was, are they too late to protect? So this is more of a protection. So you could either continue to have your part of your investment portfolio in the market, and then have some protection. Like this will go up when the market's going down. So obviously this will do very well even in a complete crash. Even down to 400, 380. So even 5,000, this is going to do great. So anything down, this does well. Rallies, then you should have some. We were talking a little bit about everyone's kind of long the market. If they have a job, if they have a house, if they have any assets, they're all kind of correlated. So if the market goes up, everyone kind of is fine. If the market just crashes, something's going on, and you want to have some protection. This is something that could give you that doesn't cost very much.
That makes sense. Cool. Well, do you want to move on to the topic this week? Volatility surfaces, Greeks, and earnings. So that's quite a wide range.
It's important to talk about. So the way I'd like to talk about it is how you summarize the volatility surface. And I'd like to look at a stock that's coming up with earnings. So in order to do that, we go to the market intelligence, And then in the market intelligence, we go to the earnings tab, and then you could see all of the stocks coming up with earnings for the week, and you could hone in by Tuesday, Wednesday, Thursday, whatever. So there's Micron. That's a pretty good name, Nike too. But let's look at Micron, and let's talk about the volatility surface. So first, the first thing we see at the earnings tab is you can see that these implied moves are these kind of shaded green and reds. The dots are what actually happened. So on this one in September, I'll kind of move it down. In September, we were implied at a 5% move. It went down 4.4%. So Micron was pretty muted. And then lately, with the AI and everything in the news and the market, I mean, look at how big these implied moves that they're looking for, Tyler. It's quite something. Yeah. So, we were cruising around the 6, and now the average is 7.8, and even at 7.8, it's still implied at a 10.1. What usually happens is what we see is when the last couple of moves have been high and especially above the implied move, like the last implied move in December was 12.5. It moved down 16.2. That's a huge move for Micron. And, so then that leads to, bigger and bigger implied moves. Traders obviously are saying, well, there's some uncertainty, a lot more uncertainty around earnings. So we're going to make that earnings straddle a lot higher. So that's the first thing. So you want to isolate, if you're trading a stock, you want to isolate all the factors and compare them historically. So now we have a pretty good feel for, well, the Micron implied earnings move, and earnings is coming up on the 28th. So, the 20th, a couple days. So that's, there's a lot of increased volatility then. And let's go see that in the trade builder, Tyler. So the trade builder is nice because you can see all the past earnings, and you can see what happened to implied volatility. That's the blue line. So let's just scroll down a little bit, and you could see that the blue line implied volatility goes up and up and up, and then on the line that shows earnings, then it crashes down and goes up and up and up to the next earnings. So that's what's happening now, and you can see that these dots represent the at-the-money volatilities for expirations coming up. Mm-hmm. So what we want to do, when we're summarizing this implied volatility skew and looking to see, where we want to trade. Like, if is there a trade here? Maybe we have Micron. What's the trade that we want to do? So, what you want to be looking at is, you want to isolate. So we looked at earnings. So that's usually the bump. And then we want to look at the implied volatility. Now we want to look at the term structure. So the term structure is based on usually all these dots. And then, what ORATS says is it comes up with two term structures, a short term or a 30-day and a long term or a 2-year. And then one of those goes up or down, and that shows you the term structure, and the bump is the earnings. So you want to isolate the earnings and see what the kind of X earnings term structure is. So you would go, X earnings, the X earnings 30 days implied volatility, whereas the current volatility is in the 60s, and that's at 30 days, and some of these are very high. But now the X earnings is down in the 50s. So we take out the earnings effect, but it's still, you could tell it's still quite high. So that's the first thing that we'll look at is, well, so as we noticed in the earnings analysis, we've noticed that it was very high compared to historical levels. And we're seeing now that the implied volatility is high. Even the X earnings volatility, taking out the earnings effect, is quite high in the front. So that's, so that's quite so that's quite something to look at. And now what we might look at is the infinite, or we could go the X earnings, and we could go down like 2 year or 1 year. So X earnings 1 year. Let's see how this looks, kind of relative to history. So how is this far out volatility looking? And that looks actually somewhat near, maybe a little bit high. You could tell over the last year it's been trending up, and it's slightly high. So that's that's something to consider. So the long-term volatility is maybe we call that fair or slightly above fair, whereas the short-term volatility is quite high. So we're trying to construct a trade here, and we're breaking down all the specific pieces. This is the kind of the point of this discussion today, Tyler, is to look at how, you come in and you see prices and then you see implied volatilities, but what does it mean? So we're breaking it down and we're looking at things historically. So now we've created a term structure, right? So we've thought about a 30-day volatility. Is that high or low? We think it's high. The earnings component of that volatility, is that high or low? We think that's high. The long-term volatility, is that high or low? That's about medium. So what do we have left to do? Like, so that gives us a whole term structure of assessment of that term structure. But now we need to look at the relationship between the low strikes and the high strikes, right, Tyler?
Right. So that would be called the slope, right? So is there there's a few other places to see this volatility structure in the dashboard, right? So you can see it in the trade builder. That's one way. You can see it in the Outlook tab. And then you can also see it in the options chain visualization that we have there, right?
Yep, those are good ways to do it. But I like to start here because I want to get a historical view of each one of the components of the volatility surface. Okay, so we've done term structure, so now we're looking at slope. So, and yeah, definitely you could see those there, but the trade builder is a really good way to assess valuation. That's why it's one of our most popular tools, or probably is the most popular tool, right? Okay, so let's look at slope. So how does this slope look to you, Tyler?
I'd say it's about moderate, leaning towards the high side.
Yeah, I'd say high. I mean, it's only one blip has been above it when it was crashing, right? So, if you look at it now, it's rarely been above that. So we have a high slope, high front, moderate back. So in this type of situation, you did a lot of work on this visual up here, which is the valuation of the volatility surface. So when it's green, that's more of a buy. When it's red, it's more of a sell, right?
And that takes into account the short and long-term volatility and the short and long-term slope.
Right. So actually, that's a good point. So let's look at the long-term slope. So I'm expecting to see the long-term. So yeah, it's pretty high too. However, yeah. So the trade here, I think, yeah, and you can see it in the shading. So the shading is red in the puts, and then it goes to kind of green in the puts. So I would like to do something like, buying. So what's the price of stock? 101. So I would do something. I would do a diagonal probably, like maybe buy the 90. Let's see. So it's cool that you could trade from this, and then let's sell some of this red area here. Okay, so we could sell that 90. So we'll sell the March. Let's sell this. Yeah, so somewhere around here. I'm using the arrow key, so it's really convenient.
Nice.
Yeah. All right, so that will be our kind of put calendar that we're going to put on for this week, Tyler.
Great. So
let's give them a little bit. We have it worth 311, so that's that SMV that's really important to look at. And we'll go out to 315, and we'll force that trade.
So that should have a high forecast edge, right? Because we're basically trading off of our volatility forecasts here.
Yeah, distribution and forecast edge are
That's a good way to like double check if you're using this method of analysis to trade.
Yep,
the forecast edge should be positive, or else you're probably reading that graph wrong.
Yeah. So those are the main things that I want to talk about for the surface is, so we talked about when you come up with the surface, you want to come up with the short-term volatility. And if you're looking at a stock, then there's a lot of earnings could be in that. And in Micron's case, there was quite a lot of earnings in there. So what we did is we said, well, let's isolate the earnings component, and let's isolate the X earnings volatility and look at those versus historical averages. Those both look very high. Then we looked at a long term, and that looked reasonable, maybe on the high side, but reasonable. And so we knew that maybe some type of a calendar seems like the best trade. And then we said, well, is it calls or puts? And then we looked at the slope, and the slope was very steep. And when ORATS says the slope is steep, it's a put call slope, so the puts are high, especially in the front. So we said, and we looked at even the coloration of the trade builder, and we said, well, it sure looks like a put calendar is the way to go here. And then you might say, well, earnings, anything could happen. It could go, if it goes up, that's going to go against us because the put calendar that we put on has we want it to go down towards it. The highest profit of the put calendar is towards the is towards the strike, right? So I'll pull up that trade again, and you could see that this is a negative delta because we want it to go down towards that strike. So the payoff picture here shows that very well, and the delta shows negative delta. So we're taking a negative stance, and what I would say to that is I would say that is true. But if you do trading enough and you're not always leaning one way or the other, the overall. You want to find the overall edge, and if it goes against you, it goes against you. That's the coin flip. But if it goes towards you, and you have a very good trade, then you could make good money on this, and it's theoretically what I would call a very good trade. And so one of the nice things about this this trade analysis, you can see the implied volatility of what you're trading. It's a 78 of that April 4th, and it's a 54, so that's a big discrepancy right there between the volatility. So we're hoping that 225 comes in. Even if it rallies, we're going to have a lot. Even if it goes up, we're going to have a fair amount of room. For example, we could show IV coming down. Now that's not really going to be that fair because we don't have it where you could isolate the IV, but the IV will come down in both, but we think it's going to go down a lot more in the front month. So, so that's why we like to trade, Tyler.
All right. Yeah, I'm looking forward to seeing how this does.
Yeah, I mean, again, if it goes up, probably going to maybe break even. If it goes down, we're going to make some good money.
Got it. All right, cool. Do you want to talk a little bit about the X earnings calculation? We referenced that a lot in this episode. How does ORATS do that calculation? What about it makes it such a unique indicator?
Yeah. Thanks for asking, Tyler. So, you could tell from these plots. So what we do is we take each one of these at the money implied volatilities, and then so each one has an earnings effect in it. Now, an earnings effect in a shorter term one, meaning a shorter term expiration at the money implied volatility, will have a much bigger effect. So if there's only 4 days, one of those 4 days is a huge move. So then what you're doing is you're moving that amount that it's going to move, and then you're trying to basically extricate that move, and then you do that for each one of them. So one with 45 days, and only one of the 45 days is a big move. That's not going to change things very much. So if you start doing that and you're solving for all of these at the same time, then you draw a rational skew. So a skew that minimizes the mean squared errors of a term structure drawn line. I know that's a little bit advanced, but that's how we start doing it. So we start, taking out, and then what about here? We come to, or you could figure it out right down here. We come to this. That's a slope. We figure out what the earnings move is, that 10%. When you take out that 10% from all of these, you're going to move the front months a lot more than the back months, that 10% move in the stock. So by doing that and solving, that 10% lines up all of the at the money implied volatilities going out the best. So that's basically how we do it.
Got it. And if you've been following our previous episodes about the macro events, it's a pretty similar calculation, right? Like in theory, and we're starting to do this same sort of calculation on the SPY with macro events. So the macro event is sort of like an earnings event for SPY, and we're doing a similar calculation to sort of track like X macro event IV. So I think that's really interesting how they're tied together.
Yeah, that's a good analogy, Tyler. So I pulled up our blog. So if you go to ORATS blog, you could see this story, and it was picked up a few other places as well. So you can see this blue line is the actual implied volatility term structure, and you can see that it's very upward sloping. There has been a lot of volatility in the market, and that's what you'll see. But there's also a lot of bumps. So bumps are what we see at earnings times or in SPY and market-wide ETFs. We see bumps when there is a macroeconomic event. So the first bump that we see, if you don't talk about Monday, but you talk about on the 19th tomorrow, is FOMC. So there's a bump, meaning the implied volatility is higher on that day than the kind of neighboring days. Mm-hmm. And so, so what we do is we do a similar type of analysis to estimate, how much more volatility is in that day. We don't call it a move, although we may start doing that, but we just say, hey, there's about 30% extra volatility in that particular day at FOMC. And a cool thing that we do is we've gone through historically and we've said, well, FOMC usually has way more than that, usually has almost double the additional volatility on that day. And the 1 day move, so the average 1 day moves, maybe 12. The average 1 day move on FOMC is 19.3. So a lot of people avoid, especially the like zero DTE traders that are short volatility, or they avoid trading on FOMC days. But what this analysis can show is that there is, there are other days that you should look at, and there are days when it's over or undervalued compared to historical. So yeah, so that's a good point, Tyler.
Yeah, really interesting, the parallels between those calculations, and that's a lot of what we do here at ORATS is adding some unique indicators for you guys to use in your analysis.
Yeah, absolutely.
You have anything else for today, Matt?
No, that was great. Yeah, nice show. And so we got a trade in Micron, so that'll be fun to watch. Our paper trader is great, and there's also a trade journal that goes along with that, so it'll be a lot of fun to watch.
All right, great. If you guys want to see the trade journal, it is in beta, so just give us an email, and we will add you to the beta. As always, thank you, Tradier, for hosting. If you guys have any questions, you can email us at support@orats.com or leave a comment in the YouTube video. Thanks, Matt, for sharing, and we'll see you guys again next week.
Thanks, Doug.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.